From the Lineweaver Wealth Watch Center, this is the Financial Quarterback.
I'm Jim Lineweaver, your financial quarterback since 1993. As we start out 2023, it's important to look back at the last year to see if it can give us any guidance about the coming year's market. So here to help us is Chartered Financial Analyst and a member of our investment committee, Jerry Herman. So Jerry, what did last year? It was a pretty rough time, but what did it really tell us?
Well, I would say 2022 is a year of recognition and reality. Recognition that the stimulus actions from prior periods needed to be unwound and that the reality of the process would be painful. Stimulus and low interest rates drove demand. With supply chain disruptions and an energy shock, inflation rose to its highest level in 4 decades. To cool inflation, the Fed began to raise rates.
Yeah, the Fed actually raised rates 7 times during the year, which are levels we haven't seen since 2008. So this made for quite a challenging market.
That's right, Jim. For the year, the S&P 500 was down 18%, the Dow was down 9%, and the growth in tech-heavy NASDAQ declined 33%. And fixed income provided little shelter. The U.S. bond index was down 13%. A hypothetical 60% equity, 40% bond portfolio experienced a loss of 16%. And it was only the 3rd time in history where both bonds and stocks were down in the same year.
So it was a very challenging year, but what can we expect in 2023?
Well, first, the economy and the markets must digest the impact of higher rates. If the Fed tightens too much and recession emerges, its depth will be reflected in earnings and market valuations. So entering 2023, there are some headwinds for equities.
Yeah, but higher rates aren't always necessarily bad, are they?
That's right. Higher yields on fixed income are a gift for investors who have been looking for income. Today, some higher quality corporate bond yields exceed the inflation rate, a historic inflation rate of 3%. So there are opportunities to generate income that we haven't seen in years.
Yes, what about inflation? For the decade ending 2020, the average rate of inflation was less than 2% before the recent spikes.
Yeah, higher rates should help bring inflation down, and investors should consider some protection against inflation.
Yeah, so it sounds like it's more important than ever for investors to make sure their portfolio is positioned appropriately, but also be able to adjust going forward.
Yeah, for now, we think there are opportunities in short-term government bonds for income. Muni bonds may offer tax advantages for high-income earners. Recession is a concern, but equities act as a good inflation hedge. So for now, within equities, we prefer areas like healthcare, energy, and financials. And after years of underperforming, value stocks are preferred over growth.
And value stocks tend to pay more dividends, which are also taxed at a lower capital gain rate. So it might be beneficial for a lot of people out there. So Jerry, thanks for all your help. Great recap of last year, but also insights for next year. So if you have any questions about your portfolio or simply want a second opinion, give us a call. We're always here to help. Stay tuned for Fox News Sunday.